Could the 1970s be making a comeback? Dean Smith of FolioBeyond weighs in on whether we're heading for stagflation, rising inflation, slowing growth, and spiking volatility. With markets swinging wildly and gold hitting new highs, are policymakers asleep at the wheel? We'll connect the dots between tariffs, rate moves, and investor risk. And at the end, you'll know if it's time to go on defense.
Gary, jumping into thing number one. So we are going to adjust from the written version. We have our guests here today. I'll let you do the intro. We are talking about, could the 70s be happening again? Stagflation. Gary, I'm going to turn it over to you to make the introduction, and looking forward to the conversation on thing number one.
All right. Thanks, Rob. I'm excited to introduce Dean Smith of FolioBeyond. His firm manages more than $100 million in a variety of bond portfolios. Dean, where are you today?
I am in Seville, Spain, and it's Holy Week, so there's lots of processions and parades and tourists, and it's a lot of fun.
Terrific. I've been there. It is a wonderful place.
Yeah, it's great.
All right. So we have been talking about the possibility of stagflation in the U.S. for a couple of years now. It looks like you think this is more of a current concern. Would love to get your thoughts on it. What are you seeing?
Yeah, I mean, there was a time not that long ago when we would have thought stagflation was dead and buried. We thought that Paul Volcker had taken a wooden stake and driven it through the heart. But there's troubling signs that we may be repeating, or at least rhyming, history now. We've got slowing economic growth that was already sort of starting to make itself more widely felt even before all of this tariff mess, there's no other word for it really, came to the fore. And obviously, inflation has been a problem for the last several years, self-inflicted in our view. It's come down a bit. It's still well above the Fed's 2% target. We can talk about different measures of it and so forth. But if you look at inflation expectations of households and businesses, those have taken a really big jump just in the last 4 or 5 weeks.
Yeah, one of the things that I think we should be looking at, and more people are starting to look at, are default rates. At what point do you think we start to see those spike?
Well, defaults defaults take some time to materialize, right? Because for both consumer as well as business loans, you first have to become delinquent. And that delinquency will take some time to work itself through. You become 30 days, 60 days, 90 days, and then there's some sort of a foreclosure process. So getting from, stress in the economic environment to actually seeing defaults occur can take some time. I'm old enough to remember the financial crisis back in 2008. In fact, I was managing a portfolio of subprime mortgage-backed securities from the short side, fortunately back then. And we, like a handful of other guys, put these shorts on late 2006, 2007, and the real defaults didn't come through until 2008, 2009. So this is something that takes a little while to build, and we're seeing some really troubling signs of it right now. In particular, we're seeing credit spreads really start to gap out. That's both on commercial as well as consumer assets, credit card, auto loans. The FHA has been very kind of quietly forbearing on delinquencies on a huge number of FHA mortgage loans. So if you look closely, you can start to see the signs of some real economic stress building right now.
Dean, we've talked about that FHA issue before on prior editions of the Five Things. My concern on this is I think they are paying the mortgages of people in order to not show defaults. or to show delinquencies. And the issue with that is you have a whole bunch of people who believe they're homeowners, but they have no money in, they're not paying anything. The American taxpayers are supporting that is very selective. It's a selective way to support the housing market. And to make things worse, when that housing doesn't go back on the market, that's how we end up with higher housing prices forever. That's why nobody in their 20s or 30s can afford to buy a house. I mean, obviously not nobody, but it's a huge issue. And I think, it's really easy for people to say, well, hey, these are poor people, we have to keep them in their homes. But when you tie that behavior and the fact that people are paying for it through more inflation, but when you tie that behavior to young people not being able to afford houses, and so they don't get married and they don't have kids, it becomes a very different problem. Any thoughts on what they should be doing with that?
Yeah, boy, this is a tough one. I mean, the FHA obviously has a mandate to support first-time home buyers, um, and one of the ways they do that is through very low down payment mortgages, sometimes as little as, just a couple of percentage points of down payment. Well, if you've got a mortgage and you've gone 6 months, 9 months of forbearance where they're just sort of taking those delinquent payments and putting them on the end, your balance is increasing. So it doesn't take very long if you've only got a 2% equity stake in the property when you buy it. It doesn't take too much deferral of interest and principal for your upside down. You have negative equity in that property. And we saw this, again, not to keep harking on the 2008 financial crisis, but we saw this in spades. And when people don't have equity, their incentive to pay that loan goes down pretty dramatically. And so, how you balance the need to maintain a sound financial system and continue to support low and moderate income homeowners, if we want to still even call them homeowners, if they don't have any equity in the home, is a really tough challenge. And we've got on the commercial side of things, they're doing something very similar. It's not a government program, but the commercial banks who are the servicers for commercial mortgage loans, and there's a huge percentage of these that are underwater, they engage in a process called extend and pretend. So for commercial mortgages, they are typically have a 10-year maturity, a 30-year amortization with a 10-year balloon payment. A large cohort of those commercial loans that were made 10, 11, 12 years ago are well past that balloon date. They can't refinance. And so they've been doing something similar that the FHA has been doing. The banks that are servicing on behalf of the owners of the commercial mortgage-backed securities that in many investors hold in insurance company portfolios and so forth. This is a problem that is only going to get worse. Interest rates, in our view, we've seen the near-term lows in this thing. We actually think that interest rates are poised to continue to stay elevated, if you want to call this elevated. There's no real easy solution here. There's not a lot of appetite for another bailout so soon after the last one. This is going to be a problem that's going to take some time to work out. We talked about interest rates being elevated, but that's only if your time horizon is the last, say, 20 years. If you go back and you look at a longer historical perspective, the 10-year generally runs around 4.25%, 4.5%. That's sort of the long-term average. So people who think that we are seeing high interest rates right now and are expecting interest rates to return to something they view as normal, 2-handle, 3-handle kind of interest rates, they're going to be in for a big disappointment. We think that interest rates are going to remain elevated and could go up. We could test the recent highs again of 4.75%, 5% without too much additional pressure on the system.
I'm with you on that, Dean. You have a lot of people who don't know a whole lot of financial history who want lots of stimulus, no recessions, low interest rates, and no inflation, which, great. And maybe a pony too. So, one last question for you. Your comment from before was that, people had thought Volcker had killed stagflation. For our viewers who, don't follow economic history in the way that Dean does, he's referring to Fed Chairman Paul Volcker, who succeeded prior Fed Chair Arthur Burns. And so the horrible inflation and stagflation of the 1970s actually started in the 1960s. And there is a story that then President Lyndon Johnson actually picked up Arthur Burns, his then Fed chairman, slammed him into a wall and told him he wanted lower rates. Burns caved and he lowered rates too early and inflation came roaring back. And it actually took Volcker pushing interest rates to around 20%, killing the economy, but that killed inflation and stagflation. Now, for the last few years, we've been saying that this is a story that Jerome Powell knows very well, that he had always, from what I understood, admired Paul Volcker, did not want to be the next Arthur Burns. And yet last September, he let up early, and we have a situation where, as soon as they lowered rates, the yield on the 10-year went up 100 basis points. Basically, the yield curve uninverted, but not in the way they were hoping. Dean, what do you think Powell's going to do now?
Yeah, I absolutely concur with what you just said. Jay Powell remembers very well. He's no spring chicken. Jay Powell is well into his 60s. He may even be 70. He remembers that time period very well, and he has no interest in being the next Arthur Burns. And again, Arthur Burns, you're right. He got pressure from the White House to cut interest rates prematurely. He did so, and we all lived, or those of us of certain age, lived to regret that time period. And Jay Powell absolutely does not want to do that again. In fact, I mean, if you watched his press conference from what was it 3 weeks ago or so, he basically put his hands in his pockets and jammed them in and said, "We're good. We're good right where we are. We don't feel the need to do anything." And so the pressure that he's getting from the administration, from Scott Bessent, the Secretary of Treasury, I don't think that's going to do much. I don't think it's going to have much of an effect. They really see the problems. Again, go back to the 1970s. What was the catalyst for the inflation that started back then? It was an external shock. It was oil prices. There were some other factors as well, but oil prices, there was an oil embargo, and that really was an external shock that caused prices to rise. What do we have now? We now have an inflationary spike that came at some people think it's come and gone. And now what are we getting? We're getting a huge external shock in the form of these tariffs. And people who, there's been a lot of rationalization about tariffs and, they're not really inflationary and U.S. consumers and businesses won't pay them, et cetera. Nonsense. Tariffs increase prices. There's just no getting around it. That's full stop. This is going to be inflationary if these tariffs go into effect to the extent that they've been outlined. Now we've got this 90-day pause, I guess. I put that pause in quotes because there's been some conversation. Well, it's not really a pause, but we have the 10%, I guess, inflation on a lot of things. They're kind of picking and choosing which commodities and which products are not going to be subject to the tariffs. It's really quite a chaotic situation now, but some form of these tariffs is going to come in. Donald Trump has been a fan of tariffs for 35 or 40 years now, and he's also a fan of low interest rates. Remember, he's a real estate developer. What do real estate developers like? They like low interest rates and lots of leverage. So you've got sort of this perfect storm of factors coming together that we think spell some real trouble for the economy and for markets. And that's why, frankly, we've been telling our investors that you need to get rid of this mentality of trying to pick bottoms and trying to time the market. it's time to play small ball. You need to reduce your risk. You need to reduce, in particularly, you need to reduce your duration of your portfolio. That is to say, your interest rate sensitivity. We think that it makes sense to reduce long duration credit risk. There's lots of things that you can do. You want to live to fight another day at this point as an investor, and I think that there's a lot of talk that you see on the financial press and on TV programs and things like that of people trying to be smarter than they really are. We think that there's, the right thing to do is to be cautious here, and as I say, live to fight another day. Preserve capital.
All right, Dean. Well, we know we're coming up on midnight there in Spain. So we're going to let you go. But thank you so much for joining us. For people who are interested in what you have to say, how can they find you?
We have all of our ETF information, the performance, the documentation, disclosure materials are at our website, FolioBeyond.com. There you'll find the information on our riser and fixed P exchange traded funds, and for you to reach out to us through the contact information on the website.
All right. Thanks, Dean. We appreciate it.
My pleasure.
Awesome. Good stuff there, Gary and Dean. Thanks so much. If it cut out, yeah, we'll definitely have a link to Folio Beyond in Dean's contact information so you can connect with him after the fact. Gary, anything else to add there?
No, as certainly an interesting segment. A lot of the things Dean talked about are going to come out later in the show. So, we'll be talking more about credit spreads, about the Federal Reserve, about inflation, and about, the Fed's options, which are not as wide as they're not as numerous as people seem to think.